Let's bring in Bilal Hafeez, Macro Hive CEO, to get his take on what is happening here. I want to start kind of more broadly about trying to get an understanding of your perception of how markets are treating all these various risks at the moment. Ukraine, we don't have an obvious exit from this situation at the moment. We don't know which way these peace negotiations are going to go. Equity markets are very buoyant right now. Bond markets are selling off. The Biden administration can't calculate the impacts of the Ukrainian war in terms of the US budget. How accurate a picture do markets represent right now in terms of reflecting where we're going? How easy is it for markets to price in? Because the bond market signal, the equity market signal, the commodity market signal all feel very different at the moment.
Yes, absolutely. I think there's lots of conflicting signals right now. I think also there's been lots of volatility in markets and lots of position unwind. So I think some of these market moves we're seeing are more a reflection of position adjustments than reflections of moves based on fundamentals. But leaving that aside, in general, over the past few weeks, what seems clear is that the market seems to be viewing the world in a more rosy perspective. Yep. Interest rates have gone up, stocks are rallying, commodity prices have come off somewhat overall. And so the market is shrugging off Ukraine risks, which I find surprising. At the same time, the market seems to be saying that the US, out of all the economies in the world, is probably best placed to benefit from all of these cross currents that we're seeing at the moment.
Okay, Bilal, the market does seem to be shrugging off Ukraine risk. It also seems by and large to be shrugging off whatever signal the bond market is sending. Our question of the day earlier was how long stocks can ignore an inverted yield curve. What would your answer be to that?
Well, I would say that at least our models suggest that now there's more than a 50% chance of a recession in the US in the next 12 months. And I think when you're in that environment, it'll be very hard for equity markets to shrug that off. And so the types of things we're likely to see now is we need to see some deterioration in some of the economic numbers in the US. So ISM numbers to start to come down, the unemployment numbers to start to deteriorate. And so once we get confirmation from some of those variables, then I think that'll be a clearer signal for equities to start to come off. But essentially, I think it will be coming soon.
What are equities signaling right now? Are they signaling we're a great hedge against inflation, or are they signaling the US economy is actually booming still? While it may come off the boil further down the road, at the moment, the situation looks at a headline level fairly strong.
Well, I think there's a few different factors. One is the way I like to look at the US stock market is looking at the performance of small cap stocks, which I think, like the Russell 2000, which I think reflect the US real economy much better than the S&P 500, which is skewed by big tech companies. And the Russell 2000 in general has essentially been going sideways for the last year or so. So that tells you there's still some underlying weakness in the economy. Then you have the big tech companies, which in some ways are the safe haven in equities. So when we had the Ukraine conflict, then you saw the S&P do well relative to other markets, partly because of the big tech companies. Then on top of that, 10-year yields haven't gone up as much as front-end yields because the curve's starting to invert. And so as long as 10-year yields or longer are stable, then that does help the big tech companies. So I think there's a safe haven dynamic within this all that's supporting some of the big tech companies.
Well, Bilal, talking of the movement in the short end of the curve, obviously that's a reflection of a market that has had to dramatically reprice its expectations for what the Federal Reserve is going to do this year. And that's not just true of the Fed. For the ECB as well, money markets now betting on 4 25 basis point hikes within the next year by next March. Do you think that's realistic?
I mean, at the moment, I think it's unrealistic, partly because if you listen to the rhetoric from the ECB, it's very, very different from the Fed. I mean, the Fed's done a dramatic pivot. Its signal shifts up in its dots in the middle of last year, and it's been very clear about the challenge of inflation. And so there's been a big pivot reversal. Everything's lined up in respect of the Fed. The ECB has been more circumspect. I think the main focus for the ECB right now is to focus on tapering, which they've started to initiate, and then what to do with the balance sheet. As for policy rate hikes, if you look at the ECB's inflation projections, in the next couple of years, they think inflation will stay around 2%, if not lower. So at this stage, they're not really telling us that they're comfortable raising policy rates. So for now, I think they're focusing much more on the balance sheet rather than raising policy rates.
Can I just come into this issue of a recession? How do you position, what do you own if you think there is a recession coming? And when critically do you want to pivot through that asset mix?
Yeah, no, that's a very good question. I mean, my bias in general, when you come close to recession, is actually to overweight cash. Because paradoxically, cash, while it doesn't give you a strong return, it doesn't lose you money. Because the main issue about recession is that stocks and other risk markets tend to suffer large drawdowns. So you need the firepower to be able to buy markets at a distressed price. So cash gives you that optionality. So my bias is to be overweight cash as you go into a recession, because then you're able to buy the drawdown. And then the other one is what's driving the recession. So at the moment, I think a big part of the global recession is commodity price increases. So I do think it does still make sense to be overweight commodities in this current environment.
Is it too late to get in on that, Bilal?
Yeah, timing for commodities, I think, is tricky right now. And I do think that ultimately oil prices and other commodity prices will go meaningfully higher from current levels. So tactically, it may make sense to hold back right now. But from a medium-term perspective, I think the time is still right to be overweight commodities.
Are you surprised that Bitcoin has basically erased its losses? Are you surprised how strong the crypto markets are right now?
Well, we've been following this very closely, as you know, Guy, and we, recently put out recommendations to go buy all sort of crypto markets. And so for us, what was important was that some of the macro relationships with crypto was starting to change, which were telling us that crypto now will be driven more by internal crypto dynamics. And then within crypto, if you look at on-chain and flow dynamics, they were all really giving you super bullish signals. So all of that was telling us that crypto is likely to go up from here. So I think the picture is very constructive from crypto. I think a lot of people, a lot of the froth has been taken out of the crypto market. And in terms of the current flows we're seeing, they're more sort of dedicated crypto players are coming in and buying crypto, which is very constructive. What
do you see the utility of crypto being in kind of a portfolio? Is it something to trade actively? Is it something to hold as a store of value? What do you view the use case as?
Well, I think there's a number of different use cases. I think something like Bitcoin, in some ways, is a buy and hold. It provides some diversification to your overall portfolio with the prospect of some quite strong returns. Then there's others like Ethereum and some of the layer one coins, such as Cardano, Solana, and so on. And they, in some ways, are like internet platform stocks. All of them can be programmed. There's apps can be built on top of them. So that, in some ways, the play for the next Facebook or something like that. Then you have all the altcoins, which are much more like venture capital. So they have more venture capital type returns because they're much more speculative. They can potentially have very high returns, but equally they could go down to zero. So I think there's a number of different risk-return characteristics that make them quite attractive.
What do you think of the Chinese markets right now? We've got this lockdown in Shanghai. We're going to be talking about that in just a moment. The zero COVID policy continues. Clearly, it's going to have an economic impact. But have markets already bottomed? Have equities in China already started to bottom? Where next?
Yeah, I mean, I'm super cautious on China, not least because even if the markets have bottomed, it's just unclear what the regulatory landscape is there. At any point in time, they might curtail the ability of private sector companies to operate. So for me, China is not really an equity play, rather it's a bond play, where you have much more visibility about your ability to buy or sell bonds. And in general, the Chinese economy, I think they're struggling to stimulate the economy. The property sector is in distress at many levels. There's zero COVID strategies really impacting consumption overall. So there's real weaknesses in the Chinese economy, which overall makes me think China is really more of a bond play than an equity play.
If you were to put money to work in the emerging markets, though, where would you put it right now? Because you look at what it's like. Latin America looks interesting. You've talked about that before in the past. If China is a risk from an equity front, where does the opportunity start to open up?
I think for now, you have to go for commodity-related EM economy. So LATAM, I think, makes most sense, both from an FX and equity perspective, because everything's lining up in their favor. Longer term, I think within Asia, India, I think is still the long-term play, because that's much more of an equity-friendly environment. I think international investors are also relatively underweight India equities relative to China in the grand scheme of things. So India as a structural play, I think, would also be the other one.
Bilal, great to catch up. Thank you very much indeed. Bilal Hafeez of Macro Hive. This is Bloomberg.